Right. So welcome to the LSE for today's hybrid event hosted by the LSE European Institute. My name is Donato Di Carlo and I'm assistant professor in political economy here at the LSE European Institute. And I'm delighted to be joined by Governor Robert Holzmann and Professor Daniela Gabor this afternoon, and to welcome both our distinguished guests to LSE for this event. I will properly introduce our speakers and discussant, our speaker and discussant shortly. But before I do so, I would like to make the following announcements. Please put your phones on silent so as not to disrupt the event. The event is being recorded and will hopefully be made available as a podcast subject to no technical difficulties. As usual, there will be the chance for you to put your questions to our speakers. And for the online audience, you can submit your questions via the Q&A feature at the bottom of your screen. When doing so, please include your name and affiliation. And for those of you here, I will let you know when we open the floor for questions. About the event, so Governor Holzmann's talk is entitled Unconventional Monetary Policy, Review, Intentions, Results, and Alternatives. The main question informing the talk is whether, assuming that inflation is tamed, we can go back to conventional monetary policy like the one practiced before 2008, or whether we have to think about new ways to conduct, again, unconventional monetary policies. This talk offers selected considerations about the intentions, effectiveness, and options of unconventional monetary policies in the euro area and beyond. The talk will be followed by Professor Daniela Gabor, who will take the stage in her role as discussant to present to us three lessons, if I can say so, right? Three lessons from unconventional monetary policy. So Robert Holzmann is an Austrian economist, governor of the Austrian Central Bank, and member of the Governing Council of the European Central Bank since 2019. He holds honorary positions at the Southwestern University in Economics and Finance, Chengdu, University of Malaya, Kuala Lumpur, and University of New South Wales, Sydney. Before his return to academia in 2011, he held various positions at the World Bank, including for 12 years being sector director and acting senior vice president. Before joining the World Bank in 1997, he was an academic in Austria and Germany and senior economist at the IMF and OECD. He has published 39 books, 41 by now, so, and over 200 articles on financial, fiscal, and social policy issues. Daniela Gabor is professor of economics at SOAS, University of London. She has served as an expert advisor for the European Parliament, the G20 under the Brazilian presidency, the United Nations Fourth Financing for Development Agenda, civil society organizations, and central banks. So she's currently running two major funded projects, one on rethinking developmentalism for climate and social justice, and a REDEF project, redesigning finance for climate justice, a big green state approach. So here we go, Governor Holzmann, please, the floor is yours.
Well, good afternoon to everybody. It's great to be back here at university, and thanks for showing up in such large numbers, or thanks for collecting a smaller room in which makes the number much larger, and thanks also for those being with us on the screens on the other side. I hope you can hear me and also are able to ask questions thereafter. The topic I selected oh, it's there. Okay. Thank you. Told me exactly. Let's move it under here.
Oh, do you want to present one? That'll be a challenge to present each other's
Okay,
slides.
not yet. Thank you. So the scene deals with something which is still in front of us after we had a lot of unconventional monetary policy. Behind us is the question now, okay, inflation has come down, will come down to 2% this year or next year, after next year. And then what? If and as we will have again challenges, monetary challenges, in which we have to use monetary policies to support the economy, to support, the inflationary path towards the 2%. Are we then ready, to go back again to unconventional monetary policy, which may have worked, may not have worked? Well, actually, we don't know this really, because at least at the level of central banks, the research into this topic is pretty limited. And even nowadays, as we have our midterm review of our strategy, when I look what happens in Frankfurt and in the countries, I see little attention put on the question I put on the table there. So the question is, how did this unconventional monetary policy work? Do we need to change it? And if so, do we have alternatives in order to deal with it? So this is the questions, and I've been turning around now for a number of years, and so different versions of this is out. This is what we are going to do about. And the answer to that is, of course, not independent what we think about R star, the natural rate of interest. Because if the natural interest stays as low as we had it in the past, where we could assume for Europe that it was at best zero, perhaps negative, if it stays as low, then we will be obliged to go back. But if something is happening that brings us the natural interest rate up again, then of course we would be able to move back again into normal policy. This is the background, and within the next, I have 30 to 45 minutes. I will walk you now through some of my consideration. Okay. I press. It looks like a polisher maker. You press the button, nothing happens. Oh yeah, good.
No, it is.
Okay, perfect. Now we have it. Good. So 4 topics I want to deal with in different speed. The first one is, of course, the question on unconventional monetary policy. What did we expect, how it worked, and did it do what we had expected? The natural question. The second one is, if and as we had some fallouts of unconventional monetary policy, then what are the implications? Was it supporting some of the inflation we had exposed to? What happens with the sustained loss of the central bank system? The third part of it is then, okay, do we have really monetary alternatives to deal with unconventional monetary policy? Yes, they may be there, but how promising are they? And last but not least is, perhaps there are some non-monetary alternatives, and more recently, that's the thinking of the last 2-3 weeks, is there may be something out we had not conjectured yet. And my colleague Isabel Schnabel had worked on it, and a paper I'm working on with some colleagues of mine, we are trying to put something on the table. Let's start with the first one. Very simple. How to say, unconventional monetary policy was triggered by the fall of the R star below a level in which the lower bound was hitting. So we needed to introduce something. But what was before? Until recently, what were our monetary instruments? Life was easy, at least for the last 2 decades before unconventional monetary policy came in. You had the monetary interest rate. It was typically the short-term interest rate. And if it needed, we put it up and we put it down. And we had their reserve requirements. And that's it, pretty much. So it was a pretty easy life. And the question was just when should we put what decision on the table, when should we do it? But life was easy. But as you know, if and as with interest rates, you move towards the lower bound, then you have problems, and particularly as work has since observed this, we may have an effective lower bound. So if we were to make the interest rate not only zero, but negative, at one moment it would become counterproductive what we're doing. And this fear for a counterproductive lower bound was the one where we moved into the area of alternative monetary policy. Now, what have been these four main areas where monetary policy had to move out and move to new areas? The first one was negative nominal interest rate. Real we had often, but nominal going beyond it. And frankly speaking, when I was a student, I would have mentioned to one of my professors, perhaps we'll have in the future introduce negative interests, monetary policy. I think I would have had to leave university, or at least they would have thrown me out of any exam, because a negative interest rate, nominal one, was simply unthinkable. Well, we introduced it. The second one was then asset purchases by the central bank, quantitative easing. There are many reasons why you may want to do quantitative easing, because of fiscal dominance, for example, but on the other hand, because you want to turn the yield curve, you want to change it around, so buying assets, and reportedly also because you want to improve the transmission mechanisms, how money is, how interest rates, affecting the outcome. So you want to change and improve the transmission mechanisms is one part of it. The third thing which has happened is funds for financing, which means that the central bank puts money on the table, pass it on to commercial banks. Yes, this always happens. But the new thing is, it was not only money on the table, the money on the table was also subsidized. So tier bank, here you have some money, and if you take the money, you get even interest rate for that if you take it and use it. Again, something which was unknown. What has happened in the past for when I was a student and an assistant professor, yes, when things got better, the bank said, okay, the fisc, the treasury will offer you subsidies, so apply for that. But the interest rate that we were charged was still positive. It was only, interest rate subsidies came to the table. And the last part, quite likely the most, sophisticated and theoretically perhaps for theorists enticing part is forward guidance, which is to say, putting it simply, I try to make a credible commitment to do something, and the public believes in it, and as they believes in it, I can do less than I would normally have to do. That's roughly the thinking about it. And the different ways of doing it, do it in a way that, like Odysseus, I do what I say I will do, or like the Delphi, I tell you something, but to some extent you have to, find out what I'm saying in order to be credible. So these have been the main parts of it. Okay, so this were the instrument introduced and applied once COVID hits and once, the inflation rate moved towards zero, even below that. And what we have here now, it's a number of slides I quickly pass over. I assume the slides afterwards become available so you can look at it. I asked the staff to put it up to the last stage, so it goes to February 25, so you can use it. So what you see on the left-hand side, is the world monetary rates. Not everything went negative, some remained positive there. On the right-hand side, you have a specific monetary rate which was used. This was the deposit rate, so the rates at which the central banks remunerate the balance sheet of banks with them. And you would see that became highly negative in some cases, how to say, over 1%, in some cases in Europe over 5%. So how to say, staggering negative numbers, would never thought about it. And more recently, after the inflation took place, you could see it went up highly. Then, how to say, you see also something which are typically, how to say, when you are at university, you don't look at it very directly. It is the question how actually the how monetary policy is done and what has happened also as part of the move towards unconventional monetary policy is to move from the left-hand side for a system in which you had a lower and a higher rate, and the market rate is this yellow moved around it. So you had a method of in which the monetary rate, how to say, was somewhat unstable, but you had a higher and the lower part of it. And as we move lower, without any decision from us, simply by the forces of the market, our deposit rates become the monetary rate instead, how to say, the marginal lending rate. This is something which has happened. And one of the discussions we have now, also as part of our monetary policy dialogue, is once we are down there, is the structural budget, which we have here, still needed? Can we able to reduce it? What's happening there? So moving away from the deposit rate to something there is what some people have in mind, others not. And this is the part how this purchase, this quantitative easing, translated into this huge amount of money held by the central banks. And as you know, a balance sheet, it's got balanced because the asset side and the liability side, it's matched. And what you see here is down here, you have the liability side in which in central banks, money is not an asset, it's a liability. Then you have the bank deposits there. And then you have other liabilities. On the other side, how it is financed, well, you have essentially this monetary policy operation, like you buy assets on the market there. It shows up then on the balance side, and a little bit of other assets and gold, of course, what you have there. And what you could see it from perhaps 1 billion, it moved up to almost 1 trillion, almost 9 trillion. A huge increase in the asset size of and liability side of a central bank. What we have, the same thing for the US, sir. The only thing is US only went to zero, not negative. And what they have there is something interesting because it may have a bearing on the way how monetary policy is transmitted. It is the way how the asset side of the central bank of the Fed is looking like. And what you have here is, what you see is that you have US treasuries, major part of it, and the other part, which is little explored in our European thinking, because it's a speciality of the US, is the mortgage-backed securities. And the question is whether this had a difference allows perhaps a more effective monetary policy, the way how it is interlinked with the system there. And then the speciality is financing. This is the funds for financing, which were given to the banks. As you could see, it existed a little bit before, but then, how to say, within close to no time, it moved up from some 600 million to over 2 trillion. That's a lot of money. And then, but also what has happened, we were able to reduce it in very little time there. But what has happened with these funds for money, they cost a lot of money because in the Austrian context, we spent about 1.7 billion euros on financing the banking system. So they profited because they did some carry trade on our behalf. And what you have there is, again, Europe is, yes, from our high levels, we reduced it here, but we still have a lot of outstanding money, which still will affect our monetary policy over recent decades. So far, to give you a very little a glimpse about the change that had taken place with unconventional monetary policy, and this amounts of money is only one element. You have the differences in the level of interest rates moving negative. So I think what we had most recently was one of the biggest experiments in monetary policy I'm aware of having this happen. So the question is, as we had it, well, how did it work out? So what were the expected effects and what were the unexpected effects there? And if you do policy, typically this should be part of any research there. And to my sorrow, I find none of these really, how to say, on the research agenda of central banks, or hardly ever in a disguised form there. The first one has to do negative interest rates, what was expected, how they would work. How does one expect that the negative interest rate helps, how to say, to foster inflation? Well, if you, how to say, are paying negative interest rates to a bank to take money, quite likely you're willing to have a higher demand for it. But there's also the other way, it's the asset effect, because interest rates become negative, then it has a positive effect on your assets you're holding, the bonds. So the level increases, so you have an asset effect. It's not only the interest rate effect, it's the asset effect, fine. But so this was the positive demand effect. But there's the other effect, which is interesting, is if you have if you provide money for nothing, actually with a subsidy there, what does it mean then, how to say, to something like enterprise behavior, something like enterprises being kept on the market, albeit they should have disappeared from the market because they're not profitable anymore. And this is something, how to say, the creation of effects on the interest rate negative policy one should have seen. The forward guidance, how to say, look promising, how to say, because they allow to introduce less instruments in order to get the same effect there. And it's also a certain signaling effect about uncertainty. And it's a good way of strategy. Quantitative easing, it's something, how to say, which should tweak, as we said, the yield curve. And with the movement of the yield curve, we want to reduce the higher end of it and hence make investments more lucrative because you pay a lower yield. And then you have the funds for lending. I was already in advance with my arguments there. This is the one I wanted already to have on the table. It has to do with what are the side effects. So one could imagine, yes, what the side effects were, but one hardly talked about the negative side effects which may have been happening. You can read it yourself. I only point out, otherwise we won't get through the 45 minutes on time. The one which has to do with zombie firms. If and as you have cheap money, it allows you to keep enterprises on the market, which should have disappeared, which is the normal behavior of a market economy. And well, there are some possible effects which can be measured there. The fund for lending, the question is, they costed money, fine. Interventions cost money, but the question still is, did they increase the lending? Because the way how they were conceived is to say, okay, you receive the subsidized resources from the central bank, but you must prove that you didn't, how to say, simply substitute them, that you had some add-on. And the question is, how much add-on happened? We only did research for Austria, but the addition there was marginal. So additional lending hardly took place. The third part is how to say this forward guidance, being able to intervene less, so lower instant views, but still having the same effects there. Is it very difficult to describe what forward guidance is doing? How to say the results are all a bit soft there, but some claim, some researchers, depends where they're coming, oh, it worked. Some claim it had no effect at all. And last but not least, quantitative easing, because there may be the most negative effects there emerging, not only. The one has to do with creating price bubbles. Because even as you have a lot of money on the table, a lot of resources were no constraint, but you have limited assets. What happens if you have a shift in the demand curve with a constant supply curve? Prices go up. And this is, of course, what's happened. London, the market for housing, don't have to tell you, I'm sure you're one of the victims there, which are there. And we find this, how to say, also in other countries. But not only the market housing, but also the question is, did it have an effect on inflation, the normal inflation there? Was the inflation moving up there? Well, how to say, for this, we may look into something which has disappeared in normal monetary policy reviews. Has M3, the money to aggregate, increased? Well, it has. Did it have an effect on inflation? We look into that, but you may also look into distortions into the price structure. So it was not an effective level, but the structure has changed. It may have moved to a less effective, efficient structure there. So there are a number of ways to look into it. So yes, there were some promising positive effects, but there are a number of negative effects. And so how much did central banks look into that with their own research? Hardly ever. But fortunately, we have academia. And so what I asked my staffer to do, and here have the hint to the paper, I think it was my staff of mine. In the meantime, it's a working paper, but it's now published. Which look into that, and they did not into expected and not expected. They did it by economic policy, contribution to price stability, economic growth, financial stability, income distribution, resources. And the paper they selected, 130 or so papers there, based on the highest ranking journals, how to say, to have a quality support, perhaps some of the papers you wrote, maybe there. And what you see, the size shows the size of the effect, and the color red, great, blue, not so great. And what you see there, you have with regards to economic growth and stability, quite often, how to say, less of an effect. And what you have there is the different instruments putting it there. It's the only publication of this kind that shows it, and it offers some kind of guidance. But believe me, it's still an unknown territory. So if you're looking for a great master PhD thesis topic, how to say, there's still a lot to do into that. We can come back to that. So, well, this was with regards to the market, this was with regard to individuals, but what have been some of the unpleasant effects for central banks there? The first one is the question, how did, for example, in particular QE, quantitative easing, so this asset purchases, what does it mean for inflation? What you have here is you have the red is the harmonized index of consumer prices. There's a red one, and what you have, the blue one is, you see here you have a big peak of money dynamics, and here you have it before inflation moves out. Here a small one, here a large one. So apparently there's something there. Another question is how to measure what is something there. Here you can, how to say, consult with Borio a famous name of the Bank for International Settlement. He's retiring this year. He has dominated the discourse for many decades there. And two publications, 23, 24 in March, February, took them out, showed essentially, this is how to say, the uncorrected one is to say, what is the coefficient between monetary growth and the coefficient and inflation? 1. So the quantity of money is still alive. And say, well, it's a bit simple. Okay, let's do it a bit more complicated. No. No, the graph is not here. When you do it more complicated and you differentiate between high and low inflation countries, it is when the inflation is moderate, there's no link, but when inflation is high, the one comes out, and as it should be, because inflation always has been a monetary phenomenon. And if there's no monetary exaggeration, there cannot be inflation. There will be changes in relative prices, but there cannot be inflation. So the one thing is, and I haven't heard anything from my colleagues there, is what does this excess of money do to inflation? So quite likely my conjecture, it contributed to the inflation which we had later on. Why didn't show up before? Because we also need a shock in order to make money trigger. If there's not a big shock, did we have a shock? Yeah, we had the price shock. Of course, it doesn't start with Putin. It started the year before, but at this time, some monetary institution missed it. The other one is then, what did this unconventional monetary policy do to our balance sheet? On the left-hand side, you have a balance sheet. I hope you still had a trading in which you can read balance sheets, so it won't go into the details there. You have the asset and liability side, but what you have there, particularly how to say this, the monetary instruments, left and the commercial banks deposits, they are very much, how to say, closely linked to that. So if and as we buy, if I buy asset, it shows up in the balance sheet. The problem is, if and as, how to say, we move now from a period in which we had low interest rates to high interest rate. Let's move back again. What we have here, the asset side, here we bought partially, dependent on the central bank. The Austrian Central Bank bought assets, but at negative interest rates. So how to say, we received interest rate, how to say, by taking on the loans. And on the right-hand side, they have you had the banks and they received low interest rate. But as this changed very quickly, we still had our asset side because they're the assets, bonds and other assets were a very long time, 20, 30 years. They're still there, very little remunerated. But suddenly, instead of zero negative interest rate, suddenly we had to pay the banks 4%. And 4%, Austrian assets, 4%, 100 billion, 4% is 4 billion of deficit. So suddenly, how to say, many of the central banks moved into negative territory. But interestingly enough, and this is, we can put an extra slide on it, not all central banks who profit from them. Italy, for example. Italy profit from them. Well, they had to pay a lot much more for how to say, when they bought asset, how to say, the providers of money insisted of a high rate of return. They didn't want to give a negative, they wanted to have a positive one. And so when it changed around, they still had to pay also the 4%. But on the asset side, they had still assets highly remunerated. As a result of it, they had a positive result in the balance sheet. Is it really so? Well, just to think about it, if you take the fisc, the government, fiscal affairs, and the central bank together as one unit, no, because it is the central bank, how to say, the budget paid high interest rates to the central bank, and the central bank has lower deficits or no deficit. So in a big wash, it didn't really matter too much on what side it was. It only showed up on a different side of it. And what you have here, this is only, how to say, the balance position, the last one, 24, for the ECB, so not for the individual central banks, but it shows how much south it's turned over the last 2 years. In Austria, we had a deficit again of something, taking off some of the reserves of some 2 billion. And the Bundesbank last week announced 20 billion. So enormous amounts of money. So this is true. So our unconventional monetary balance sheet has put us into deep, deep trouble. How long will the trouble last? Well, it depends on what additional position what you are. In some countries, could be Austria, it takes to the 2040s before we are May. Don't write it down, sir. May. Okay. It may May 2040 because, first of all, you have to be profitable again. Once you're profitable again, this may happen in 3-4 years down the road. You have to repay the money you borrowed, you created, but you have to pay a price for it. And this interest rate, you have to pay for that. You have to pay interest rates of quite some money there. And once, to say, you have paid this offer, you better put up some reserves of some size in order to deal with the next unconventional monetary policy use. And this assumes there will be no crisis in the meantime, which means then, that we have to think quite practically about monetary policy. So do we have instruments to keep this in check? Yes, we do. And these are the instruments of the past, but hopefully also the instruments of the future. Because as I said at the beginning, we had two main instruments in the past. We had the instrument of interest, which we still have. And the second instrument we had, which is the minimum reserve, which means on the reserves the bank owed with us, we may or may not pay the minimum reserves we ask from them. And what has happened in the past is we only remunerated those reserves above a certain minimum. And for the rest, we didn't remunerate them. And in this case, the market mechanism is not impeded because of the margin, they get remunerated, but a lot of it they don't get it. And what's the rate of minimum reserves there? Well, it could be very high, well over 10%, in some cases 50%, 20%. What was it, for example, for Croatia before they joined 2 years ago? It was around 10%, so very high. It is now 0, as for all of us. So the minimum reserves is one way in order to capture some of the profits the banks were away. Do they like it? Of course not. They say this is a tax on banks. Or I claim it's a reasonable instrument in order to keep our deficits in check. And I was waiting for him to say here, not yet. Paul? Paul de Graube, one of your professors, he wrote a number of great articles about it in order to make this point very well. And you can read his paper, 24 paper, in order to make it happen. And I hope he still shows up. So how many minutes do I have left?
5.
5, oh, perfect. Okay, I'm in time. So very quickly then, when I say, okay, well, this doesn't look too enticing to go back to what we were before, because if we don't get minimum reserves and remunerated back again, we will be back to a cycle of losses and perhaps some gains there. And we will get better research or more research of how the other instruments have done. So going back and applying them as they are, perhaps it's not a good idea. So what are the alternatives there? And the problem are they're relatively little. Very quickly, the first one is it's called make-up strategy. So if and as you didn't hit the path as you can compensate it. But next time, theoretically well thought through, but what does it require? You need, how to say, the superwoman or superman, full rationality that it is to work. I know we have superwomen, supermen here in the room, but not everybody is that. So I don't think it will work. The second part of it is the asymmetric reaction function. So if and as, how to say, you have problems, well, if you are on the negative side, inflation is too low, you really move in, but if inflation is too high, a bit more soft, again, the same assumption, you need to be super rational to make it happen. The third part of it is, how to say, Blanchard came up with this all the time, with this, hitting the lower bound, well, with 2%, it's clear it's easier to hit the lower bound. So why don't you make our life easier? You make the inflation target not 2%, but 4%. So we have much more wiggle room in order to introduce, how to say, the policies there. Well, the problem is, in theory, we have the distributed effects there, 1%, 2%, 3%, 4%. The amounts, the differences over time are huge. And if you don't have the right instruments to protect the poor, this is going to backfire. So these are the three alternatives I came up with, others came up with. So the alternatives don't stand there. And then I'm already here with it. I won't go to it, everything there from the beginning towards the end. I talked about it in the summary. I will put your attention to the last part, because this is the, how to say, the change over the last few weeks, which may have happened. And great research. I've worked with a former staff colleague of mine on this topic. Because I said, we have a problem if the R-star, so this neutral rate of interest, remains low or becomes even more negative. But more recently, we have estimates, including from ECB, that R-star from -2 moved up to 0 plus minus. And it may move up higher. How come? I've always been a fan of R-star, found always fascinating. And I always said, well, the easy part of it, why R-star may have been declined, because these are the easy explanations, because they are in pure logic with economic thinking. For a real interest rate, you need productivity. No productivity, no real interest rate, somebody has to pay for that. The other part, of course, it's demography. Because if you have a growing population, means labor supply, even without an economy which is productive, you can pay an interest rate. Why? Because the younger population is larger than the older population. So you get, how to say, a real interest rate, or go back to 1958, Samuelson, he already found out, how to say, why you may have a positive interest rate even in an economy without productivity. So what it showed, okay, we saw historically a fall in the interest rate, but this fall was much larger than the fall in productivity and population. So there was something more. And if you go back to the IMF publication, and I finish in 1 minute, of 23, where they had a lot of research on R-star, and there they have estimates for US and Europe since 1880. You see it walks up, comes down, goes to the mid of the 1930s up again, and comes down. If this has some real funding, which means, something else is there. What is it there? Well, there may be a mechanism of money which changes things around. The most simple thinking is that until recently, we had, particularly in Europe and the world, we had an demand for a safe asset. And this over demand for a safe asset meant, that the convenience yield could be lower than otherwise. That's the reason why it came down. Now we have an oversupply. Now it moves up again. So we have a monetary element, which we did not fully understand yet. If you want to get the lyrics there, Schnabel, Isabel, 2 or 3 weeks ago had a great paper there. Here comes the hero of you are the hero with regards to the minimum reserves there. Anyhow, introduced you, and I made this out of it. You buy me a drink, okay? Out of it, sir. So we have now something a battle to solve. Why, how to say it, may move up again. But how this works, the interactions with the monetary system, it's still unknown, but for this we have research. So be invited to participate in the solution. Thank you very much.
Good afternoon, everybody. It's very exciting for me to be here. I've studied central banks and talked to central bankers for a very long time. And it's exciting to talk to them when you haven't seen their slides before, and you have to make up some ideas or some insights. And you will see that we kind of overlap in certain areas. And so I have anticipated some of your intuitions. And I thought, given that this is supposed to be a conversation, I thought I would be slightly provocative in my reflections, just to make for an interesting conversation. And here are my 3 lessons, or my 3 provocations in terms of what can we learn from the last 15, 17 years of unconventional monetary policies. And I have 3 lessons. One has to do a kind of monetary theoretical lesson that asks the question, is there a theoretical foundation for us to return to conventional monetary policy and to what we call monetary dominance, which is inflation targeting central banks or institutional independent from fiscal authorities and from governments, and they do their price stability unhindered. A second lesson is a macro-financial lesson, and I'll tell you in a second about, it's a story about the financial structures in the Eurozone and in the Euro area. And the third one is a geopolitical lesson. I think as a political economist, I also like to think about questions of political economy, of central banking, given where we are now in the global economy. And I'm allowed to say more things than the governor about where we are now, and we'll take it with that. So, my first provocation is that the theoretical central banks in general like to defend the existing regime of monetary dominance, that is the institutional separation between the government and the central bank, because the idea is otherwise they can't do their price stability job properly. There will be fiscal dominance, and the governor referred to fiscal dominance. And the theory behind it, in the beginning, or best expressed, and I think the governor also touched on that, came from Milton Friedman and monetarism, and that theory somehow assumes that there is a clear direct relationship between the size of the central bank's balance sheet, between the amount of money sloshing around in the economy, and inflation rates. And I picked here a couple of graphs from the ECB presentations. And I would say one of the reasons why central banks have done quantitative tightening for the last couple of years is the situation that they have to shrink their balance sheet in order to get inflation under control. And you will see that the ECB has shrunk at a faster pace than the Federal Reserve and the Bank of England. And you could say, if you're a central banker, yes, of course, this explains why inflation has come under control. There is less money in the economy chasing goods and services. Inflation is under control. But if you look at this graph of the Eurosystem balance sheets, I brought some balance sheets as well, you can see that the European interbank markets and money markets in general are awash with excess liquidity. There is still a lot of excess liquidity in the system. So this tight relationship, empirical relationship between the size of the balance sheet of the central bank and inflation is not there anymore. It's very questionable in my view. Then we come to the second, the more sophisticated account of the theoretical foundations for monetary dominance is that we have the famous R star, the governor referred to it, but the governor didn't say something that I thought was interesting that you mentioned in other speeches, which is it might be policy dependent. if it's policy dependent, in other words, if the R-star moves with monetary and fiscal policy, then the entire edifice of new Keynesian inflation targeting regime kind of collapses on its own. And we can talk more about this. I only have 10 minutes, but I'm happy to elaborate it. The third problem of the theoretical foundations of inflation targeting, to my mind, is that we heard inflation is always, this is what central bankers usually say, inflation is always and everywhere a monetary phenomena. And when Milton Friedman said that, he basically meant it's a monetary phenomena that accommodates fiscal spending, that accommodates fiscal expansions. But we know from the IMF that there is no clear relationship between stimulus spending and higher inflation since 2020. We can't draw a very clear relationship between the two. In other words, countries who spend more fiscally didn't get higher inflation. The story there kind of theoretically collapses there as well. So I would say we are on shaky theoretical grounds for monetary dominance. I want to then go to the macro-financial lesson of unconventional monetary policies. And here, let me start with a graph that central banks usually like to show, which is very significant government bond purchases by the ECB in particular, but any other large central bank that is shrinking slowly, not because the ECB is doing active quantitative tightening, but because the unwinding of long-term refinancing operations. But I want to tell you a different story about government bonds in the euro area. And this different story has to do with the fact that for quite a while, central banks have ignored the macro-financial role of sovereign bonds. What do I mean by this? European money markets, and this, I'm showing you the European repo market, where most banks and non-banks are financing and moving liquidity around, has increased very massively. It's around 11 trillion euros at the moment. And a lot of it is circulating government bond collateral. A lot of financial institutions are financing their government bond portfolios there. Therefore, the sovereign bonds play a role beyond their fiscal. We tend to think of them as a fiscal instrument. They are a macro-financial instrument for the financing of the European economy and for the financing of European financial institutions in general. And with this, at the beginning, and you could think until Mario Draghi came to the European Central Bank, most central bankers in the euro area did not want to recognize this idea. But with the outright monetary transactions and then with a speech by Benoît Cœuré from the ECB in 2016, there is now an implicit recognition that sovereign bonds or money or a money equivalent in collateral intensive financial system. And that's exactly what we have in the euro area and in the United States as well. Because government bonds work as money in collateral-based financial systems, government bonds have a macro-financial role and central banks can't step away, they have to intervene. And we know, and this is something, when I think of unconventional monetary policy, I don't just think of quantitative easing, I think about market maker of last resort for government bonds. The Bank of England has adopted formally since 2015, the ECB has various names for it, outright monetary transactions, whatever it takes, transmission protection instrument. These are various labels to mean that a central bank can no longer allow a fiscal crisis in the Eurozone unless if it wants to have financial stability. And here, I think we have to think very carefully about what this means. And although the governor fleshed out some concerns about the losses that central banks might be bearing over a long time horizon, my bigger concern is that we have a stronger monetary dominance in the euro area in particular, but elsewhere as well. We have an increase in the fiscal power of central banks because their decisions about when and how to sell government bonds, when and how to allow redemptions to run their course, gives them fiscal powers that should not be with a technocratic institution. And I'm happy to discuss this further. And I just wanted to say, related to this, a lesson about unconventional monetary policy that we don't often hear has to do with the ECB's climate policies. After Christine Lagarde became governor, the ECB talked about climate a lot. And what we know now from the speeches, in particular of Isabel Schnabel, who was mentioned today, what we know is that the ECB's unconventional corporate bond portfolio has a carbon bias. In other words, the ECB is doing credit policy by de facto subsidizing carbon-intensive assets in the euro area. And the program to tilt the corporate bond portfolio acknowledge this. It has been suspended since June 2023, again, under the guise or under the concerns of preserving the specific monetary dominance that says you can't do credit policy, otherwise you lose central bank independence. But my claim is the ECB and central banks in general, once they have unconventional bond portfolios, or once they accept in their collateral portfolio corporate bonds, they're already doing credit policy. And the final one, and I'm going to leave you with this, the geopolitical lesson. I am a bit more skeptical about the future of the European Union. I'm a Romanian citizen. I don't want to be skeptical. I want it to go well. But we're living new geopolitical realities, and these new geopolitical realities require us to think more carefully and to ask more careful questions about the role of monetary independence, about the role of central bank independence and the position of monetary dominance. And we know these new geopolitical realities. Everybody wants to make clean industry or arms industry great again. The European Union has launched various initiatives. They are not working very well. We have to be clear. There are other countries in the world that are doing a much better job of both green industrial policy and other kinds of industrial policy. And my last provocation is, if this is the new geopolitical reality in which we live, is this augmented monetary dominance where central banks have acquired since 2008 bigger fiscal powers, a bigger fiscal footprint in the countries where they're operating, is it appropriate for the kind of world that we live in? Should we start reconsidering and think about new mechanisms for fiscal monetary coordination, when for most countries, the question of how do we pay for transformation, or how do we pay for new industries, or how do we pay for things to be different, when it becomes a survival question? I'll stop here. Thank you.
Thank you. Thank you very much for these two very rich presentations. And we will now open the floor to questions from the audience, both here and online. If you're online, please type short questions into the Q&A box, and we will try to answer as many as possible, and include also your name and affiliation. And for those here, please raise your hand and I will select. I would say we proceed with we collect 3 questions, and then we give you the opportunity to reply. So we have all 1, 2, 3, please.
Okay, thank you very much. Thank you, Robert, for this fantastic speech, although I shouldn't say that I missed the whole of your speech. But I read your paper. I read your paper in preparation to this meeting, and I'm telling you it's a great paper, and I really want to use it also for my students in the list of things that I have to read, because it's very illuminating. But that's not exactly what I want to do now. I want to ask you a question, because you are on the governing council. You are one of these guys who have to act to make it, right? And the question that I have is the following. In the fight against inflation by the ECB up to now has been spending 270 billion euro total, right? Since the start of the increase in interest rate. 270 billion euro has been transferred from the national central banks of the euro system towards commercial banks, right? A huge number. The yearly spending by the EU is 160 billion. We have spent, I think, 130 billion for Ukraine in the last 3 years, with a lot of trouble to get it done. Yet, and the ECB has been, with an incredible largesse, distributing billions and billions of euros to the banks. Now, you may say, well, that's fine if all this led to results, right? That it might have been worth the price. And we paid a lot of money. We could have done nice things with all this money, but you might argue we had to do it. And that's how we fought inflation. And so it was worth the cost. But then I look at the inflation numbers, right? Well, you know them better than I do. You started with the ECB to raise the interest rate in September 22 or something, right? When the inflation was at the peak, it was about 10%. And then during a year, you raised the rate of interest to a little more than 4%, 1 year, right? And when you reached that, inflation had dropped to 2.4%. So you may say, wow, great success. The ECB raised the interest rate in 1 year from 0 to 4 point something, and inflation dropped from 10 to 2.4%. Now we know from empirical literature that there are long lags, right? And interest rates affect the economy with a long lag, with at least a year. So it's quite implausible that the drop in inflation that occurred after 1 year was due to what you did there, right? It's much more plausible that it was related to some other variable, in particular energy prices. When you look at energy prices, during that 1 year, or just actually 6 months earlier, they dropped precipitously. So you may argue that had you not increased the interest rate, nothing would have been different, or very little would have been different. So why did you spend so much money? And it's unclear whether your interest rate policy really did it, really managed to reduce inflation. I would like to have your opinion about this, whether you follow me, or whether you think that, yes, the ECB was instrumental in fighting inflation. Therefore, the money we spent on the banks, who are very happy these days, was worth spending.
Thank you. Thank you. We have a second question.
Yes, so thank you. David Marsh. So my question follows on a little bit from what Paul has said, but I wanted to ask you, Robert, it also ties in with something that you said, Daniela. It seems to me, listening to you, you've been at the ECB now for 6 years. You've been a kind of unconventional central banker because you came from outside the milieu. And you seem to be asking quite a lot of quite searching questions, which, as you say, the research has not looked at. So the question to you is, this is an independent central bank, but it seems to be very dependent on itself. It hasn't become somehow independent of itself. It almost seems to have developed a kind of self-preservation mechanism. It's almost like a kind of internal Stockholm syndrome, because it needs to be very, very secure in itself. It's not asking any ugly questions. And then from what you said, Daniela, it has actually crossed the Rubicon. Central banks in general have crossed the Rubicon into becoming political institutions. And yet the ECB is protected by this kind of carapace of supreme independence. When Christine Lagarde goes to Eurofin meetings, she asks all kinds of unkind questions and puts all sorts of unkind remarks to the finance ministers, telling them what to do. They don't dare to ask her or to give her any prescriptions because it's against the law. So the question is, Robert, in these 6 years, do you think that the central bank has become so impervious to the outside world, it doesn't really take any notice of any kind of independent research that might be asking some searching questions?
Thanks. Third question.
Hello, my name is Dario. I'm in the political economy of Europe course. I'd like to thank you both for your talk. And I'd like to ask a question about the last point Professor Gaber made. And I think it's a great forum where this point was made kind of in different directions, and which was addressed before as well, talking about central bank money. And my question would be, from both of your guys' perspectives, what role should monetarism play, any role in financing, for example, the green transition or other more political goals, and why, or particularly why not? What is the thinking about that at the moment, and how has it evolved ever since we have crossed the Rubicon? Thank you.
Right. If I may add, to which accountability mechanisms, right? Yes, please, I would like you to give you the chance to reply. And then we'll take a second round of questions.
Thanks, sir. Most thankful, provocative question. Could we have done it simply? Well, our problem was that we started too late. So to say perhaps half a year too late. And perhaps we stopped half a year too late as well in order to make it happen. But with regards to actions, the problem always seeing it through. But the seeing it through assumes, how to say, that our expectations of the people don't change. And so the question is, if we had not intervened, we still have made head that the inflationary expectations may have changed and not led to the fall in inflation. And what we found out is that with the high inflation, expectation started to lift up. They were not constant. So what you have in mind works if you have constant inflation expectation. They were not constant now. Now we have them again, but now, how to say again, they are moving upward. So this is part of it, because if and as you have price shocks, supply shocks, then in principle you should look through. But the question is, it's only useful if inflation expectation don't move. Typically move. This would be my first answer to that. David's also a provocative question about a central bank independence. Yes, there may be some kind of ignorance there, as always. You create a special reputation and you try to live on it. But I still believe, and this links also to the points you made, I still believe, how to say, that independence, and this is always the question, has done more good than bad compared to fiscal dominance. Because politicians, ever since, how to say, Greek times, Roman times, they don't live, how to say, by nothing. They need to give gifts. They need to give money away. Otherwise, they cannot buy. So that's the part of it. And if you don't restrict them, they can up with any kind of funny invention. The latest one we see now, how to say, the politicians in the UK, in Germany, in Austria, they were all afraid now that they have now do the hard tour, bringing the budget deficit back to the 3%, and then afterwards even save in order to make the changes and finance them. So fortunately, we had Putin to offer them an opportunity to say, oh no, now we need to have our defense union and now we can spend. For me, it's more a way of avoiding the hard way. So this would be my interpretation. And the second part is, if and as the studies I know about the link, you said it doesn't exist. The papers I read, but perhaps the different papers that also shows quite clearly, how to say, that central banks' independence, it's an important, very important, sometimes the only variable which determines whether a country has convergence, for example. So I think, how to say, that's, of course, I'm biased. I have to, I'm not without that. And then over there, Mario, the question there. Let me, one word, what was it then?
Sorry?
Can remind me with one word,
Financing green transition and monetary policy.
No. Green finance. Okay, two small stories. I recall that a newspaper said, oh, the Austrian National Bank is financing 30 industries because we bought a bond by the biggest Austrian firm, which is ÖMV, which is mineral oil. So they are subsidizing what they're doing there. Well, I invited the CEO for lunch, and what he told me was unexpected. And this has happened in the meantime. He needed the money to move from oil production towards the production of products, not oil anymore. And now, just last week or so, they built now the biggest, it was the biggest firm by now. Now it's one together with other, some 60 billion, quite a big for Austria there. So the money was used to transform an oil-producing company into a non-oil producing company. Why did they do that? They used the old name. Well, if you go on the market with a new name without credibility, what happens? They have to pay a higher price. So you want to use the old name instead of the new name to save money in order to do the transformation. So the simple looking into that, what is notionally the case, it's not the case. Number one. And number two is, frankly speaking, I'm not a big fan of this green finance, because I believe bankers are very intelligent, one of the most intelligent people I come across, to find excuses there. So, in order to sell something there. But I have a strong belief in financial markets, that they know how to say what kind of companies will survive or not. And the example I gave her, go back 20 years ago, 25 years ago, what were the biggest company, the most capital-rich companies in the world on the stock market? Oil-producing company. Where are they now? 200. So the market knew how to price it. So we don't know how to say these phony experiments where we satisfy some clientele there. The market knows how to do. We only have to make sure that the market happening, and perhaps the market also does it to current political events, but they don't want to talk to them. So this is my answer. Okay.
Thank you. Perhaps I can say in response to Paul's question that it seems to me, Governor, that inflationary expectations are for central banks what the capital markets union are for European politicians. This kind of magic thing that you take out of the pocket to say, well, that's our explanation for how things work.
It's a good one.
Yes, it's a good one, yes. Well, I mean, of course, it's I would say it's an easy one, but we can have a longer conversation. I'm not sure it was inflationary expectations or it was energy prices, and that's a different story about what drives inflation, whether it's cost shocks or demand. And I'm not sure that the Eurozone had excess demand and had the kind of, and it needed an interest rate response in order to deal with inflation. So I would say maybe there is some disagreement there. On the question of, I think the way that you responded to David, if I may, to David's question is to say that we can't trust politicians, although you seem to trust the CEO of a fossil fuel company. I have the opposite view in some ways. Said we can't trust politicians and central banks have to discipline them in some way, I guess, via monetary policy or via fiscal positions. As a citizen who likes to participate in democratic politics, I have to believe that somehow politicians are able to express our collective views about the direction in which we want to take. And I'm not sure that the technocratic institutions should be in the business of disciplining politicians. But that, I guess, boils down to political differences in whether you believe politicians are inherently a set of, I wouldn't say corrupt political actors, but self-interested political actors who just buy votes by doing populism, which I think is how you put it. I tend to think that there can be some kind of, civil servants and politicians who think about public good rather than think about their political careers in a kind of self-reinforcing loop.
Some will, but the majority not. Some will.
And how do we know this?
Where are they?
Yeah.
We don't have to, because we don't give the possibility.
Well, I would say this is a very strong conservative position, which I do not share. I think in democratic societies, if we assign technocratic institutions the role of disciplining and politicians, we run into very serious dangers about political polarization and the rise of the far right. And we have to be careful when we say things like this.
But here, sorry, that's now they talk about monetary policy, but this was the whole come into being of central banks. Central banks were always created at the moment of cleaning up after wars, preparing for wars, doing what of this. So the modern central banker was created in order to create this monetary stability, what policymakers a lot in history have violated. So it's fully clear that then we also must be responsible. But the one is, to say, like others, I show up twice a year at the parliament there. They can any kind of question, ask them whatever it is, and I try with our research other parts to make it happen. So it's not, how to say, I'm there, can be there, jump up and down and whatever it is, how to say, I'm also subject to some kind of what is it, sanction, and this also has to do how people are elected, etc. It's not that also we're up there and we don't have any kind of political supervision.
Yeah, on the green transition question, I'm not sure whether you were not persuaded by Isabel Schnabel's arguments that market neutrality in the design of unconventional bond purchases creates a carbon bias, in the sense that if you buy corporate bonds following existing capital market volumes, and these existing market capital volumes are determined by, a past of fossil fuel companies being very powerful, then by definition, you are subsidizing fossil intensive companies. You said, okay, but we are subsidizing them with a view towards helping them transition into either renewables or other kinds of activities. My sense is that the tilting of the corporate bond portfolio was about doing exactly that, but not just by trusting the CEOs to do that, because we can see with Shell and other fossil fuel companies that they have completely walked back on their promises to do renewables. So to me, if there is a need to discipline a particular actor in the economy, given the overall green ambitions of the European Union, fossil fuel capital has to be disciplined, and that's exactly what the European Central Bank was doing with the tilting of its corporate bond portfolio.
Yeah, when there was a hype there, I understand that, and it needed to be political, etc. But if and as one looks into how it works out, the need in order to have all the data there. Behind this, you have a huge data industry costing millions of dollar, pounds, whatever it is, to make it sure. And I have the discussion since my time at the World Bank, where the same thing came up, where I'm very green, but I don't think this is the most efficient way of doing it. So I think if and as, and I'm very much in favor of carbon taxes, because that's an easy way in order to price there out of it. Here we have, how to say, the effects very easily. The rest of really walk down first and inform yourself what it means to make it happen. If you have to, those who buy it and what, then they have to make sure that where they buy it, the whole purchase chain down there. It's impossible. It creates a lot of income for some groups of people, but the effectiveness is much less than if you have the prices. That's the part of it. You can do something, but my sense is that the effort is not worth the money. That's the part to say that it wouldn't work in one way or other, but it's not the most effective way. That's how to say. So we're not so far away, but I think it's an ineffective way.
So we have questions from the online, right?
This question is from Piroska Najib. Thank you, Governor Holzmann, for the excellent presentation. My question is about the future role of ECB in what appears to be a warlike economy in Europe. Historically, wars are financed by central bank financing. Do you see a role for ECB QE to finance EU defense expenditures?
Any other questions from the online? No. So then I would say we take 3 more questions from the room, and then we give the presenters the last opportunity to reply. Please.
Yeah, thank you. I'm Emil from SOAS. Governor, you mentioned during your studies that bringing up negative nominal interest rates would have resulted in getting you kicked out of uni. With this
Sorry,
one,
it's. I have to get up to you.
Yeah, could you speak up, please?
I speak up there because don't speak up there only.
you mentioned that if you had brought up negative nominal interest rates during your studies in university, that would have resulted in you getting kicked out of university.
Yes.
With this in mind, what do you think of price controls and the whole sellers inflation discussion today with Isabella Rivas research?
Thank you. We have another question here from the gentleman.
Thank you. Yeah, my name is Robert Heath. I'm at LSE alumni. I was interested in the international context here. One of the criticisms of particularly quantitative easing was the impact it had on other countries, particularly emerging markets, in that it disrupted their monetary policy through spillover capital flows. And of course, could have had an impact back on the European economy through impact on exchange rates. So I wondered what extent was and is the broader international context taken into account in these decisions.
And we have one last question.
Thank you. Sophie from SOAS as well. I wanted to ask you how big you see are the chances that the 2% inflation target is shifted, or it's because you also mentioned it in your presentation, and what are the chances that it will be before inflation, or if there is always going to be an inflation target in the ECB? Thank you.
One last question. So women are encouraged to ask questions as well.
Particular to women, okay, show solidarity, okay.
No, the women should ask you questions.
Fine with me. I'm a tolerant person.
So if there is no last question, then I would give you the last 5 minutes. You can pick and choose as you please.
Yeah, no, starting up from below. Well, any inflation target is a kind of a trade-off what we have. The first question always is, why do we need an inflation target at all? Or why do we need inflation at all? Should we have zero inflation? Principle, yes, but in this case, negative price developments on average, how to say, have some repercussions. And the question whether it's 2% is the best one, it emerged, how to say, as a kind of a consensus around central bank. It didn't have always the same. And I think a lot of research had to do that. Research became international. Estimates there and found out 2% is a kind of a good compromise between some inflation or not. And the reason some inflation is useful is because it allows you to provide some kind of wage reduction in case you need it without cutting nominal wages because the real wages fall. And this is a way in order, how to say, to offer adjustment for some countries or another. And this is the way where some inflation emerged as a kind of a compromise, but nothing is written in stone. International context, yes, since I have IMF and World Bank experience, how to say, emerging economies, developing economies are very much on my mind. And what we know is even as the big institution, the big countries, I would say, create hiccups, it is the third world which is hampered by it. And here then institutions come to the table like World Bank and IMF. The problem what we currently have, and we will see it down the road when we are in Washington, you know, what's the this big person there is thinking now about what to do with the IMF and World Bank, believe them or not. Otherwise, inside the IMF, I was making sure that the resources are there. And one of the things, for example, what the ECB has been doing over recent years, and they claim that Austria had something to do with it, to throw lines, credit lines, and other support lines to our neighboring countries. Because even as you use the euro, you need to have some new liquidity if it comes to shove. So we have implemented them, and the US, as the dominant monetary economy, has also been doing it. If and as or the herd now that wants to cut these lines is of course a catastrophe, because you need it, because if there's not certainty by the financial market that resources are going to be used, this could be traumatic. So you have a major point there one should look at. Price control. Well, price control is a legitimate instrument where it fits, where you want to have it, when in the case where supply doesn't shift, it's fixed during wars, where you have fixed amount of goods which are distributed, goods to have some price flexibility for allocation purposes. But if you cannot increase the supply, let's say of meat, in this case, I would say fixing price good. Otherwise, I think it's better to have some room for flexibility, because they're coming back again, allowing bureaucrats to make these decisions there. It's good, but only to some extent. And ECB war, well, that's a dicey question. We have not discussed it yet. We alluded to it, But here the question is, let's assume now I will say this purchase takes place, or the idea of purchases takes place, and then I will say there's the need then to find financing for that, or okay, and then to say, okay, no, we have to do something else. Either your question comes up, can we allow them, not civil servants, but independent, to say, okay, we don't like the war, or oh, we like the war, you have the money, but likely not. So our decision, how we would react to that, we haven't made it yet. We alluded to it, but the discussion has not yet happened. That's the ECB Council.
Okay, just very
2 minutes. Yeah.
very quickly on price controls. I think there is a more recent literature that says if you have corporations that are abusing market power in order to extract excessive profits, then price controls are a legitimate measure, even outside conditions of war. I guess you could ask your counterpart at the Bank of Spain whether he thinks the Spanish successful experiment with price controls is some kind of a reflection of war conditions or not, and I'm not sure. But of course, there is a question of how do we design price controls that work? And Hungary didn't design price controls that work, Spain did. It's a long conversation, but I'm not sure it's just a war thing. And if we take seriously the idea that increasingly more significant climate events, and I think they're quite possible, will trigger supply shocks and will trigger inflationary pressures way beyond the 2% that some central banks are comfortable with, then relying on the banning of inflationary expectations and on interest rates to changes that to me is not the right way forward. On the question of spillovers from monetary policy, Hélène Ray, who's also here somewhere in London, but at the London Business School, has done great work on the global financial cycle, and we know that countries, rich central banks or countries central banks in rich countries do not have a national mandate. They can't think about spillovers to other countries. They can't think about their contribution to the global financial cycle. But the IMF, at least since 2012, accepts that capital controls are a legitimate measure or means to try to reduce the vulnerability to I would say, I don't know, a wall of money coming from quantitative easing or all sorts of other questions. Unfortunately, not many countries want to use capital controls because the imperative of market access is so powerful and everybody fears of becoming Argentina that they haven't been used in practice. So there is a long ongoing debate around the reform of the international financial architecture, and I'm not sure only central banks should be part of that conversation. And there was
Last remark, concluding remarks.
that's it. Thank you. That's it.
So it's been a great pleasure to have the opportunity to chair this lively session and to listen to the discussion. Thanks to all of you in the audience who joined us here and online. And a very special thanks to Governor Holzmann and Professor Gabor. Please join me in giving a round of applause.